Hi, I'm John McRobert, and I'd like to share with you now about a way of budgeting a seed business that begins with looking at your overheads and then builds a framework around that to define the other components of the business. We know that every business has overheads, or what we might call operational costs, or some people like to call them wealth creating costs. And these are costs which you can't do without. You have to spend them to make your business function and run. And so it's a cost that you need to cover with the profits that you make, or with the gross margin that you make from your enterprises. So I want to show you a way of doing this that will just build a framework for a budget and a business plan. So let's have a look at that now. So every business has what we might call operational costs. Operational costs, which are costs you can't avoid. They are costs which enable you to run the business, like having a shed that you pay rent on, or having vehicles to move around on, salaries to pay so that you can have workers, telephone, internet, a whole range of electricity costs which are just there, and the business has to pay those month by month. Now, some people call these overheads, and others, I've heard a phrase called wealth generating costs. And I really like this wealth generating cost, because it helps you to think about these costs as being very important for the business to make money. And therefore you will only spend money on these costs if they are contributing to the functioning and profit making or wealth making of the business. For example, if you're going to spend money on a vehicle, that vehicle must be used for the business, and every trip that it takes must contribute to earning income for the business or saving costs for the business. So these are monthly costs. They are monthly, and let's just take, for example, they are costing you $2,000 per month. Okay, that means it's equal to $24,000 per year. So that cost you have to cover. Now, in a business, when you build up a business, you want to have a product that you are producing and selling. And when you produce that item or items like seed, there's a cost associated with that. So we have what we call a gross margin. Some people call this the gross profit, but for me it's the gross margin, which is equal to the income that you earn from selling that product minus the costs of those goods that you've sold. In this case we're talking about seed. So that gross margin, in a typical business, you want that to equal about 50%. In other words, 50% of your income is costs, and the remaining 50% is what's available to use in your business. So that's a kind of rule of thumb that you want. Now, your overheads or your operational costs are going to come out of that gross margin. And as a rule of thumb, again, you want about a half of that, or 25% of your income being spent on your operational costs. So 50% in this case is the cost, okay, but our gross margin is 50%. So half of that, which is 25%, is going to be spent on operational costs. And then of course we want to make a profit, okay, and our profit is going to be the remainder. So we've got 50% here, which half of that, 25%, is going to be used on operational costs, which means our profit can be 25%. So these two add up to the gross margin. Okay, so we now realize that 25% of our income is going to go towards our operational costs. So how much income do we need to cover our operational costs? So our income that we need is going to be 24,000 divided by 0.25, okay, which is going to equal to $96,000. That is now our income that we require to cover our operational costs, if 25% of that is going to go towards operational costs. Now we also know that our gross margin is 50%, therefore our cost of goods sold is equal to 50%. So our cost of goods sold is equal to 50% of $96,000, which is equal to $48,000. So that now specifies the maximum we can spend on the cost of goods that we will sell, 48,000. So we've now defined our budget pretty well, but the last thing is we're going to end up with profit, which is going to be our net profit before tax, okay, because tax is going to come out of this net profit, and that's going to be equal to this income minus our cost of goods sold minus our overhead costs or operational costs. So our profit in this case is 96 minus 48 minus 24, which is going to be $24,000, or 25% of our total income. So now we have defined our budget, our plan. From this we can specify, or we can determine two things. We can determine our seed that we must sell, the quantity of seed we must sell, and the selling price of that seed. So let's just look at this gross margin here, or our cost of goods, okay. Let's say we are going to spend on our goods that we are going to produce, in this case seed, we are going to spend $1,000 per ton to produce and get that seed ready for sale. Therefore, we can only produce actually 48,000 divided by 1,000, which is 48 tons. We can only produce 48 tons at $1,000 a ton. So we've got 48 tons to sell. So what price can we sell that 48 tons at? Well, we need an income of $96,000, and we have seed 48 tons. So if we divide these two, we get $2,000 per ton. So now we've established two things: how much seed we must produce and at what price we must sell it. So now we have the outline, the framework for a budget that we can build up, and we can dig down into each of these items and really build up a budget within the constraints that we've defined, in order that we will reach this net profit before tax of $24,000. Now I have a little spreadsheet that I can show you that does these calculations for you and adds a little bit more information. So let's go and have a look at that.
Here we have the simple spreadsheet that calculates your budget parameters based on your operational costs. Now in this instance, like I showed you on the paper, we have our operational costs of $2,000 per month, which comes to $24,000 per year. Now if our operational costs are 25% of our income, then it calculates all these things based on a gross margin of 50%. So in this case, we need to sell 48 tons of seed in order to earn $96,000 at $2 a kilogram. If our gross margin is 50%, then 50% of the selling price is the cost of the seed, which is $1 per kg, and our operational costs are equivalent to 50 cents per kg. So our net profit before tax is 50 cents per kg, or 24,000, and that represents 25% of our gross income. Now, there are only two ways that you can increase the profit on your business. Is either to increase your gross margin. So if we put this up to 60%, what that means is that only 40% of your income is costs, or is attributed, or is assigned to costs. So therefore, your profit increases to 33,600, or 35%, because you've got more of a margin over costs at that price. And the other way to improve your profit is to decrease your operating. If we reduce our operating cost to 20%, our profit goes up to 30% with a gross margin of 50%. So you can see these equations are actually very simple and interconnected. And what happens if you increase your price? Well, if you increase your price to say $3 at the same gross margin, you can sell less seed, okay, to get the same profit in this case. So increasing price it enables you to sell less seed for the same profit, and it also gives you, if your gross margin remains the same, it gives you more leeway on your seed cost. So you can play around with these figures for your scenario, but the point is to make sure that your business can cover your operating costs, and that you get a sufficient gross margin in order to give you a good profit, or the profit that you require. On the spreadsheet, you also have the break-even sales, which is 21 tons. So you see, you need to sell 30 tons in order to get this profit. But if you just break even, in other words, you don't make a profit or a loss, you have to sell 21 tons. If you sell more than 21 tons, up to 30 tons, you're going to start getting more and more profit. Similarly, it calculates the break-even price, which is $2.10 in this scenario. So if you sell at a price less than $2.10, you are going to make a loss, even if you sell the 30 tons. So the higher the price above $2.10, the more profit you will make.
Okay, so there you have it, a framework to budget your business based on your operational cost that you must cover with the income that you earn. And from that you can build up your cost of goods sold, what you can only spend on cost of goods sold, and what profit you would expect to get out of the business with a certain gross margin and a selling price. So I hope that was useful to you. If you have any comments or questions, you can email me. I'll put my email address up there, and if you want the spreadsheet, I'll be happy to send it to you. So thank you very much for watching. Bye for now.